Welcome to Topic 5, Part 1, Revisiting Financial Statement Analysis. This topic builds upon your knowledge from 1A Accounting, where you undertook the calculation of financial statement analysis ratios. We continue along in this topic, focusing on how to use those ratios, conduct analysis, but not on the calculation. In 1B, we give you a list of ratios and show you how they are calculated. The ratio list is provided in the final exam. You can find a copy of this sheet on the Moodle site. What we focus on in this topic in 1B is an understanding and application of the ratios. We are not testing you on how to calculate the ratios. You did that already in 1A. So in 1B, we focus in on analyzing the data about companies and your ability to interpret what the ratios are saying. So I suggest if you've forgotten about what the ratios are estimating, how they're calculated, have a look at that ratio sheet on Moodle in Topic 5. Refresh your memory on how the ratios are calculated, and if necessary, you can revise the relevant chapters in the Trotman et al. Textbook that you looked at in 1A. This video focuses on pricing and valuation, comparative analysis. We are also aware that pricing and valuation is conducted in finance courses. What we are showing you in this accounting course is some ways that you can understand accounting numbers. So in the following topic, looking at accounting policy choice, we can see how accounting choices are ultimately affecting those accounting numbers. So for example, when we use a cash flow number, and in the cash flow topic, we estimated the accruals and removed them to get back to cash flows, we can understand that there's assumptions and estimates built into accrual numbers. Ideally, what we're showing you in accounting will give you a competitive advantage because you can analyze the financial information, understanding what is built into accounting numbers. We are also interested in this topic at looking at macroeconomic conditions and what we call special situations. So we're mainly focusing in on some investment decisions. So for example, should I buy shares in McDonald's or should I buy shares in Burger King? So this topic prepares you in terms of analyzing financial statement information for two companies in order to make an investment decision. Typically, we are trading off one company off against another. And so what is the best investment that we can make? So in terms of conducting some analysis, a very good starting point is Yahoo Finance, or you can use Google Finance. You start off by typing in the company's name, their code. So for McDonald's, you can put in MCD into the top section here, and you can find out some information about the company's current share price, what dollar value that the shares are trading at. So let's go click through, and when you search in Google into Yahoo Finance or Google Finance, you'll find similar information like this. So in terms of the numbers, what are the most important ones that investors look at? The first being the PE ratio. So this is the company's current share price divided by earnings, where earnings is equivalent to net profit. The other figure that's of interest is EPS. This is earnings divided by the number of shares outstanding. So earnings being net profit, number of shares outstanding means the number of shares that the company has issued at this point. So remembering from the equities topic that companies can issue shares and it can be issued on a stock exchange. So it's the number of shares that have been issued. So let's return to price equity. What does the PE ratio tell us? So it tells us how much an investor has to pay to buy $1 of McDonald's earnings for this company. So that is essentially how much can $1 buy of net profit for the company. So a great thing about ratios is that they effectively scale out currency. So remember that there's currency, US dollars in the numerator and US dollars in the denominator. So share prices for McDonald's is expressed in US dollars and earnings is expressed in US dollars. So we've scaled out the currency. So we could compare McDonald's to any Australian company or a Chinese company or a UK company because we've scaled out the currency. So we can take that price earnings figure and then we can compare it for McDonald's competitors. So now we're going to click on the left-hand side button called competitors, and Yahoo is then going to show us 3 competitors plus an industry average. So if we're thinking about buying a share of McDonald's, we need to compare it with some other companies in the industry. This is to tell us whether it's a good buy or not. So based on gross margin, we can look at firstly, so it's got an underline here. So what's gross margin telling us? It's telling us how effective a company is at generating sales divided by the net profit. So sales less cost of goods sold divided by net profit. So McDonald's, it clearly has the highest gross margin of the peer competitors that we've got there, plus higher than the industry. So what does that tell us about McDonald's? It tells us that McDonald's is either more effective at generating sales or more effective at keeping its cost of sales lower than its competitors. So that's all we can really tell from gross margin. Price earnings ratio. So we look at further down the page. So we can see that the price earnings, what does it tell us? Once again, it's reminding you, it tells you how much an investor needs to pay for $1 of earnings of the company. So in terms of when we compare McDonald's with the competitors, we can see that the price earnings of the Yum brands is higher than McDonald's. So it means that the Yum brands, which includes Pizza Hut, KFC, and Taco Bell, costs more than McDonald's for buying $1 of earnings, because both of them are about buying $1 of earnings. The company that is lower than McDonald's is BKC. So if we were to click onto BKC and find out more information, it would tell us that this company includes Burger King. So Burger King, it's only $12.02 to buy $1 of earnings. McDonald's, $16.49. So McDonald's is more overvalued than Burger King for the price earnings. So it costs more to buy $1 of earnings. We can also look at the PEG. PEG is the growth of the price earnings ratio. So a growth measure, and once again, McDonald's is the highest compared with the other companies and with the industry. We can also have a look at earnings per share. Earnings per share is routinely looked at by analysts and investors, but it's not necessarily a good starting point or a good analysis for comparing companies. We can think about this from an accounting perspective because what's included in the denominator, so it's earnings or net profit divided by number of shares outstanding, that we can influence the denominator by issuing more shares or buying back shares and not influence at all the net profit in the numerator. So it's easy to change earnings per share through the denominator, which does not necessarily reflect the performance of the company. If you're to click on the headlines on the left-hand side, you can get some newspaper articles. If you click on analyst opinion, we can see what analysts think about McDonald's. So let's click on analyst opinion. And you can see that analysts have issued opinions such as buy, hold, neutral, etc. about McDonald's. In 1B, when we calculate price targets, we're really only considering 2 options. So you're going to provide a recommendation for someone who's interested in buying shares in that particular company, and you're going to give a recommendation of usually either a buy or a sell. So if a target price is equal to the current share price, that's an unusual circumstance, but we could give a hold. but typically in 1B it works out that we either have a buy or a sell recommendation. So we've got some information about McDonald's, and we might be interested, should we invest in McDonald's? And we can compare it with the Yum brands. So let's have a look, and maybe we want to find a peer comparison company, because this investment decision, we're trading off between one company and another company, which is a better investment. So in the 2011 semester 2 supplementary exam, we looked at Apple Corporation, which its ticker code is AAPL. Let's start off by considering what would be a comparable firm for Woolworths. We could choose Coles, but there's a problem here. Coles was purchased several years ago by the Wesfarmers Group. The Wesfarmers Group includes coal mining and production, gas processing distribution, industrial safety products, chemicals, fertilizers, investment businesses, all of this along with the retail. So it's quite difficult to compare Wesfarmers with Woolworths. How do I know what's included in Wesfarmers, or that Coles is purchased by Wesfarmers? Well, I used Yahoo Finance, and I just looked for more information about Coles. So we can then turn to another likely competitor, so IGA. IGA is owned by Metcash. So it could be that IGA is not a good comparison to Woolworths because of its size. IGA is much smaller. It has much fewer locations, which you can tell from just looking around. You can observe this. IGAs are also independently run as franchises. This is a different business model than Woolworths. Woolworths owns and operates all of its stores. They don't franchise. So this is something you can observe in practice. So if you visit an IGA, you can compare it to a Woolworths. You could even talk to the employees at an IGA and then talk to employees at a Woolworths. Find out, are they a franchise? Are they independently owned? These are things you can find out. You could also find them out from Google. You can Google information about IGA, and it would tell you very quickly that they operate in a franchise model. You could compare the number of stores that there are for Woolworths with the number of stores that there are for IGA. Now we turn to Aldi. Aldi is another supermarket type competitor. They are also quite small in terms of they have fewer stores than Woolworths. One of the main challenges for Aldi is that it's very difficult to obtain financial information. This is because Aldi is entirely privately owned, as opposed to being publicly owned on a stock exchange. Aldi is an incredibly secretive company, and it's very hard to find anything about them. How do I know this? Well, I can look at Google, I can look at newspaper articles. One newspaper article that I found indicates that the family who own Aldi are very concerned about keeping the company's information secret. So based on all of this, it is very difficult to get any information about Aldi, and we are unable to use it as a comparison company for Woolworths. What about Costco? So Costco is a competitor to Woolworths as well. They're both in the supermarket sector. But let's consider Costco. What's their business model? Well, Costco has items that are sold in bulk, and customers must be members of Costco in order to shop there. This is a very different business model to Woolworths. So we would have to keep it in mind if we were going to use Costco as a comparison for Woolworths. So Woolworths, we've looked through all of these alternatives, and it does appear that in Australia there are very few competitors that we can benchmark Woolworths against. So in the event that we can't find any supermarkets to compare Woolworths with, we could turn to the industry numbers. So Yahoo Finance, you recall on the previous slides, provides us with an industry average number. So this is an average of the companies in the same industry code as Woolworths. So if we can't find any suitable peer companies for Woolworths, we could instead look at the industry. Another alternative could be to look at Woolworths' past performance and see how it compares to its current performance. So we could look at its performance from last year or 2 years ago or 4 years ago and compare it with the current performance. So the second half of the slide is looking back at Apple Corporation. So we can apply the same sort of steps and processes that we did for Woolworths previously and look to find a competitor for Apple. So for Apple, we need to keep in mind what business model does Apple have. So it's got its desktops, laptops, tablets. So it designs these computing devices and it sells. It sells them through physical stores and online stores. It also sells mobile phones, also iPods, etc. It has music. It sells music through the Apple Store. It also has a subscription to a music radio sort of station or a mix similar to Spotify. So we need to keep all of this in mind when we're looking for a company that operates in similar business circumstances to Apple. So on this slide, we can see companies that they come to mind when we're thinking about trying to find a peer comparison company with Apple. So Disney, we know, makes movies. Sony produces music CDs. So they sell music, and Sony also has entered into the phone market and has handheld devices. They have cameras. RIM, this is the company which designs and sells Blackberry phones. That was a type of mobile phone. It used to be a #1 seller of business phones and has subsequently fallen out of that race. It's lost a lot of market share. DELL designs, manufactures, and sells desktops, laptop computers, and DELL has a network type model for manufacturing its computers, where it's got a network of subsidiaries for different components. So let's consider a past exam question. So this part of the question is asking for one reason why your choice of peer comparison company is suitable or appropriate. So we need to look at finding a peer company and having it supported by a reason. So in order to get the marks for this question, you need to use a bit of general business knowledge and suggest why, once you've selected that company, it is a good match. So the peer comparison company, you can say that it is a similar industry, it sells similar products, that kind of reason, and you need to be specific. So in this model answer, it says that they've chosen Hewlett Packard because it sells computers and Apple sells computers too. So that's really important. How do you build up your business knowledge? Well, you can do this by reading newspaper articles. You can go into Google, you can select Google News, and you can search by a company's name. And you can look for information about that company. So in 1B, we focus on companies that you interact with. And you can see in the tutorial question, we look at airlines. We also look at fast food companies. And in these slides, we're looking at Apple and other technology companies. So how about when we compare Apple to Hewlett Packard? So they're similar, but can we acknowledge if there are some differences? So the second part, so part C of this question is asking why your choice of peer comparison company may not be appropriate. So here you're demonstrating some knowledge about how these two companies might not be a good fit. So when we look at Apple compared to Hewlett Packard, then Hewlett Packard may not be a good peer comparison because Apple has a cult following. So people queue up to get the latest iPhone outside the Apple shop, but have you ever seen anyone queuing up outside of the Hewlett Packard shop to get the latest desktop computer? Well, you haven't. It doesn't happen. So Hewlett Packard does not have this really strong fan base that Apple has. And Apple has cultivated this by specially focusing on design of their products, whereas Hewlett Packard does not. So this might be something that you can mention is something that means that the two companies are not maybe the most appropriate match. And so you can acknowledge that limitation. So in terms of the answer, this is sort of summarizing the difference between Apple and Hewlett Packard. So Apple has focused on this design of products. They have focused on a model such that all of their devices are integrated. So once you buy an iPhone, you're more likely to then buy one of their laptops because the iPhone, the laptop can talk to each other. So the products are very integrated and everyone gets very excited. There's a very cult following. People queue up to get the latest iPhone. Hewlett Packard is much more focused on volume and business sales and keeping costs down. So Hewlett Packard's model is a very different business model to Apple, but they both sell computers. So when you look at a business model, you should think about in terms of when you're comparing companies, where is that particular company getting the money from, or where are they making their sales? And in terms of the software market, we can look at different companies have strategies to try to like where in the process to sell their product. This will help you to understand when you're looking for competitors whether one company is using a similar business model to another. So Microsoft has tended in the past to have a product, and the software product would, once you purchased it, you had a perpetual license. So you had it for an unlimited period of time. So we can compare that to the fruit of a tree in terms of that product is not going to generate any more revenue. So it is an end product. So this second example, McAfee, is one of those security softwares, that virus protection. And so they tend to have a periodic license. So you can buy a yearly or a monthly license to be covered by the security software. So the periodic license is more like the tree in terms of it is a productive asset. So once a customer has downloaded this security software, they must continue to renew the license each period, and they give a payment to McAfee to have that continued coverage. So interestingly, in recent years, Microsoft has moved towards that more subscription type model. So you now have to repurchase your license for the Microsoft systems each year. So for the Word, Excel, PowerPoint package, the latest packages, you're essentially doing a yearly payment for these. Then we've got Accenture and Infosystems. These two are dealing directly with customers on a one-on-one basis. They're developing more consulting, service type arrangements. So they work with a customer. So for example, when David Jones wanted to have a new cash register system, they could have gone to Accenture or Infosys and worked with them to get this new software. So in the bottom half of the slide, we're looking at turnover versus margin. So it's important to consider whether a company is more focusing on a lower margin or higher turnover. So if you have low margin per product but high turnover, you can generate more profits. But if you have a very high margin on your products, you can have a very low turnover and still generate a lot of profit. So the examples we've got here is Woolworths. They would have a very high turnover. So people would buy bread and milk and toothpaste on a daily basis, but the margin on those might be as low as 10 cents or $1 per product. We can compare that with David Jones. Also down the bottom of the slide, Prada. These would have extremely high margin but low turnover. So it could be that it costs Prada or David Jones a very low amount to make a product or to purchase a product, but when they sell it, the sales price is considerably higher than the cost. So they would have lower turnover than Woolworths. So this is why we may not want to compare Woolworths with Prada because of that difference in terms of business model. So let's consider some competitive threats for Apple. So one of them is that there are ongoing lawsuits where Samsung is suing Apple, and this is about design, software, and so it's a cost of being in this industry. Also, Apple has developed a steady state of introducing a new iPhone model each year, and then an S model in the second years. And so it's possible that Apple might be saturating the market. They may no longer able to be selling iPhones once everyone has a phone. So what about the threats for Hewlett Packard? So they are competing on price, not really on innovation. So this means that as long as they can keep costs down, they can remain competitive with their from their peers. But the sacrifice, if they're not investing in R&D, so research and development, they may not necessarily be able to get those cost breakthroughs. So now we consider what we call special circumstances in 1B. So these are serious game changers for a company. So these are something that you should tell someone, you should keep them informed if they're considering about buying shares in a company. So how do you find out about these? So you need to go into Google News, put the company's name in, and see whether there's anything significant that might influence on whether or not someone should buy shares in a company. So in terms of on this slide, we have some items that might be significant for if you're considering buying shares in Apple. One of them that's a significant game changer for Apple was that the CEO, Steve Jobs, passed away in 2011. We can say that this was a special circumstance because Apple CEO, Steve Jobs, was very involved in the company. He was involved in designing their products, in setting the company's strategic direction. So it's not just enough to say that a company CEO has died and that that's a special circumstance. You actually need to look a little bit further and find out whether the CEO was heavily involved in the company. So in this past exam question, it's asking you to consider some special circumstances or context that might affect your analysis. So we can look to two special situations. So here we put up first that Steve Jobs passed away, and that was in 2011. And then we also have the rivalry between Android with the platforms by Google that might erode their dominance. So how about we think about today? What special situations can we think about today? Well, we can say that Google has actually launched their own phone, which is it's a game changer called the Mosaic. So that might affect the sales of the iPhone. Another special situation that affects Apple is that the Samsung Galaxy Note 7s have been exploding, and Samsung has had to issue a recall on all of the Note 7s. So this is likely to damage Samsung's reputation and could influence potential customers to choose an Apple iPhone over a Samsung phone. So how did I find all that information? Well, I looked on Google, I looked at newspaper articles, and I got that information, and I can use that information to answer this question. So in terms of using ratios that you learned in 1A, we can select some of those out to help determine for an investor whether we should buy or sell shares in a particular company when compared to a suitable competitor. So in 1B, we give you that ratio list, and you'll have that list of calculations in the final exam. You can see that up on Moodle. We're not expecting you to memorize the ratios. What we do is we give you the list, and then we expect you to use your knowledge about those ratios to apply them to the question. So applying those principles to the facts of the case. In the real world, there are many different versions of the ratios. So for the purposes of 1B, just use our list version. Just keep things simple. In order to estimate profitability, you might want to be looking at the company. Does it have a positive return? Does it have a return on equity, return on assets? Are they greater than the comparison company? So let's have a look also at some activity turnover. If we compare Woolworths with Apple, Woolworths we can see has a much more rapid turnover of inventory than Apple. This is probably driven by the fact that customers buy fresh food weekly, sometimes daily, but do not buy iPhones, computers, so Apple's products, on a daily basis. So Woolworths, it also has a diverse product range. So that might help explain why it has 26.6 days in inventory. So it has some items that don't turn over as quickly compared to Apple with 5.2 days. Let's think about Apple's business model. It tends to keep low inventories on hand in its stores, and it can sell out of products, especially during initial launches of new iPhones, new iPads. So they're turning over their inventory and converting it into sales in a much quicker time period. If we consider also Prada and LVMH, which is Louis Vuitton Group, both of these have a very slow turnover, so 45 days. So the margin of one of these products, we need to remember, is considerably higher than on the margin on bread, milk, or toothpaste for Woolworths. So Prada and Louis Vuitton can still be quite profitable, even though it takes 45 days for their inventory to sell. So they might sell one handbag, and the margin on that might be 5,000%, whereas Woolworths is turning over inventory quite rapidly but has a much lower margin. Now, if we consider liquidity ratios, there was a traditional and old view about the current ratio, which that one was always better, or at least above one. So if it was above one, the company's current assets were covering its current liabilities. However, we contrast this with a modern view, that is that below one is better, so such that a company doesn't have idle cash, i.e. that they are using other people's money to fund the company. So essentially the company is using its accounts payable to generate sales rather than the company's own money. So they are leveraging off of their accounts payable in order to make sales. We need to recall that there's a trade-off between liquidity and solvency. So if a company does not have a current ratio of at least equal to 1, they are in danger of becoming insolvent. So the company may not be able to cover its current assets with its current liability, so to cover its current cash flows. So if we consider solvency, a company with higher debts and low interest coverage may not be able to sustain their current level of debts. So covering cash inflows to cash outflows. So which industries can sustain high leverage? So Woolworths is one example. So Woolworths is in a relatively stable industry, and it's a more or less a duopoly of supermarkets in Australia. There's two main players, Coles and Woolworths. And so if you see any of these conditions that are on the slide, you might tend to see a company with higher leverage. The opposite, if they don't have these, then they tend to have lower leverage. So for valuation analysis, we combine comparative and valuation analysis together. We're going to use a peer company, a peer comparison, and we're going to make some estimates about the market's expectation for that peer company to grow. So we typically use the price earnings ratio in this analysis, and it can tell us whether a company compared to its peers is less overvalued or more overvalued. So we're going to use some valuation techniques. So we're essentially using a peer competitor firm as a benchmark to compare the firm of interest for the investment decision. So remembering that if there's a low PE, it's a cheap stock. This suggests that the company is comparatively undervalued and it might be a good buy. The alternative is if the PE is high, it's an expensive share. It may be a bad buy. So we're going to use the PEs. So here we have some PEs that are taken from Yahoo as well as some other information. And we're interested to compare Apple with some competitors. In the tutorial question, you can see we focused on airlines. So we can compare Apple with Google, Hewlett-Packard, and RMMI, where RMMI is the company that makes Blackberries, and they recently changed their ticker code to BBRY, so it can more resemble a Blackberry. So having a look, the price earnings of Apple, $13.26. So remembering that's the price that an investor would pay to buy $1 of earnings of Apple. So Apple's PE is much higher than for Hewlett-Packard and BlackBerry. But Google's PE is much higher than Apple. So Google is more overvalued than Apple, and Apple is more overvalued than Hewlett-Packard and BlackBerry. So in terms of the PE, when we give you a data set, and you'll see this on Yahoo Finance as well, we tend to have multiple measures of the price earnings ratio. So when you look at a table and you see there's usually a PE that's historical, so trailing, that's for the PE for the last 12 months. There's a forward, so looking to this current financial year, and a forecast. So the forecast PE is typically 3 to 5 years out. So it's useful for us to have the three different PEs because sometimes a PE is negative, which means it's not very useful to us in calculating ratios. In terms of it's going to give us a negative amount of the price target calculation. And you'll see this for the tutorial question for the airlines. So in the case where the historical PE is negative, you would want to then use the forward or the forecast PE. We're never going to tell you exactly which PE to use. That is your decision that you have to make. You have to start looking at the numbers and looking at whether the company's performance is consistent with that forward and the forecast. Maybe they're more consistent, and you want to use those, and then you can compare those to the same forward or forecast number for the peer competitor. So in this past exam question, you are asked to calculate a price target for Apple. So we do this based on the peer comparison company. And so we've chosen Google here as the peer comparison company. And so we take Apple's share price, then multiply it by Google's price earnings divided by Apple's price earnings. So this gives us a kind of a growth rate. So we're considering, what if Apple grew to the same level as Google? So do we think there's some growth in Apple's share price? So this gives us a target price of $537.75, which is greater than the current share price at this point of $366.99 per share. So if the target is greater than the current share price, then you issue a buy recommendation. So we can then compare with Hewlett Packard instead. So if we believe that Apple its growth rate is going to be similar to Hewlett Packard, which is much less price earnings. So we believe that in a way that Apple's price earnings is overvalued, and we calculate the price target using Hewlett Packard, it gives us a price target of $167.44. So it's less than the current share price. So we would issue a sell recommendation. So doing this calculation shows you that you can't just apply the calculations in a blind fashion. You need to actually have a little bit of business knowledge to know why there is a difference between Hewlett Packard and Apple. So the fact that Apple has that cult following and it has a different business range than Hewlett Packard helps us to explain why Hewlett Packard may not be a good or a suitable peer comparison company. This might help explain why this price target calculation is not necessarily a good one to follow. So the PEG is price earnings growth. So it's the price earnings ratio of the company divided by the growth in the price earnings. So the PEG ratio is essentially scaled. So we've divided through by the number of shares inside that calculation. So the PEG greater than 1, it's overvalued. Less than 1, it's undervalued. So we can look at the PEG for Apple, compare it with Google, Hewlett Packard, Blackberry, and we can see that they're all under 1, less than 1, and the highest is Hewlett Packard. So we can think about the growth rate of the company. Is that growth sustainable? Will the company still be around in 5 years, for example? And the PEG ratio can help us to calculate the price earnings rate in future years and a growth rate. So you can use the PEG in terms of price target calculations as well. So what would be the price target calculation for Apple? And we use the PEG. So we would look at a normalized PEG of 1 divided by Apple's PEG, and this would be a price target greater than the current share price. So we'd recommend a buy. If we also use Hewlett Packard's PEG in the calculation at the bottom, we'd also recommend a buy. So you can use price to book ratio as an alternative, especially if the price earnings ratio is negative. You could switch to using price to book ratio instead for a price target calculation. There are other methodologies that are used in the real world to do valuation, and we've listed these here, but they're not examinable in 1B. So in terms of looking at some market and macroeconomic factors, it's important to look at the economies that the companies operate in. So those economies might lead to some factors that are necessary for us to consider.